Stays at Baa2, which is 2 notches above sub-investment or junk status. And its outlook also stays unchanged at negative. It follows the release of yet another rating agency, Fitch's statement last night. That agency changed its outlook on the country's rating from stable to negative, citing political tensions, a lack of economic reforms and questionable governance levels. The local currency didn't move much from Friday's market close of 14.10 against the US dollar.
A sigh of relief, with 2 ratings agencies down and 1 more to go. Observers remarked that it was worrying that Fitch had now placed the country on negative watch.
The adverse outcome from Fitch was quite hectic. They've already downgraded effectively South Africa 3-4 months ago when they changed the rating from local and foreign denominated to be the same. To come out again within a few months to give us a negative outlook was very ominous. Although we're still in investment grade, the Fitch decision was quite adverse, more than what I would have expected.
The reasons cited by the 2 agencies for a possible downgrade remain the same. These include the need for South Africa to implement structural reforms, improve its growth prospects, quell political tensions that could undermine contributions to growth, and for the country's debt levels to be stabilised. The fear that state-owned enterprises will continue to be a burden to the fiscus also remains. But so far, though, it looks like Team South Africa has done enough to stave off junk.
I think there's a few things that are contributing to this outcome. The work that has been done not only by the National Treasury, but that from business and labour are making a positive contribution. But we've put ourselves now under the spotlight. Going forward, depending on what Standard & Poor's does, and I get a feeling they'll be in the same line, they are unlikely to downgrade us to junk, and they'll sound more hawkish. They'll want more economic reforms.
The country, which is struggling to get economic growth on track, can ill afford a junk status rating. Such an eventuality would push up the cost of borrowing for government and the banking sector. That could translate to development projects being put on hold or being done at extremely elevated costs. And for consumers, it could mean paying more for financial services. Investors who are mandated to not invest in junk-graded assets would immediately sell out of South African bonds and equities, which would result in a sell-off in the local currency, which would translate to higher inflation and ultimately higher interest rates. S&P could make all this a reality next week by downgrading the country's credit rating to junk, but there's optimism that it won't. Not yet, anyway. Nomphumelelo Siziba, SABC News, Johannesburg.